Alright, buckle up, because what happened in the markets today, February 4th, 2026, around 10 a.m. New York time, is not just another volatile session. We saw gold smash through $5,000 an ounce like it was nothing, a record-shattering move, an incredible $135 uptick in just 24 hours. But here's the kicker. At the exact same time, Bitcoin was getting absolutely steamrolled, dropping thousands of dollars in a single day, collapsing through critical support levels. This isn't normal. This isn't just noise. This is a macro earthquake, folks, and if you're not seeing the full picture, you're missing the entire story. Let me know in the comments where you're watching from and what time it is for you. Hit that subscribe button, join the community, and type Gold 5K in the chat if you're ready to dive deep into what's really happening. Today's moves tell us everything about the future of global liquidity, trust, and the next regime shift. What we saw today wasn't just about a single headline, it was about deep fundamental shifts, a convergence of forces that are pushing this market to a breaking point. There are three major threads driving this unprecedented market action, and missing even one of them means you misunderstand the entire chessboard. First, we're going to break down this incredible market divergence itself, gold soaring to all-time highs while Bitcoin crashes, and why the mainstream narrative completely missed the real signal. Second, we'll expose the hidden policy and currency forces at play, specifically how the new Federal Reserve Chair nomination is ripping through the system, and how what central banks say they want often clashes with what the system actually rewards. And third, we're going to peel back the layers of market plumbing, revealing who's truly trapped, where the liquidity stress is building in real time, and why this is just the beginning of a much larger structural shift. Let's start with thread 1, the market move itself. Look at gold, closing today north of $5,048 an ounce. That's not just an asset moving, that's a statement. It's up over 25% since the start of 2025 and 76% in the last year alone. This isn't a mere reaction to a headline, this is a systemic bid, a demand for trust when trust in everything else is eroding. And why now? Why such an explosive move today? Because this isn't just about inflation hedging anymore, though that's certainly part of it. It's about a deep repricing of the future of money. Gold is acting like a safe haven, sure, but also a sovereign hedge. Investors are sensing a regime shift, a pivot point where the value proposition of fiat currency is being fundamentally questioned. This isn't a topping move, a speculative froth about to burst. This looks like a shakeout of the weak hands and the confirmation of a new, higher baseline for real assets driven by structural, not cyclical, forces. When bad news hits, how does the market react? How does it close? Gold held every gain, closing strong, demonstrating incredible relative strength. It's behaving like a sovereign-grade asset, drawing capital that's fleeing uncertainty elsewhere. Now contrast that with Bitcoin, down to $76,350 today from over $80,000 just yesterday, a 13% drop so far this year. Why the massive divergence? Mainstream pundits will tell you it's profit-taking or market volatility. That's superficial. Here's the trader logic. Gold is an absence of counterparty risk. Bitcoin, for all its revolutionary promise, still carries substantial counterparty and regulatory risk, especially with the explosion of the stablecoin ecosystem and on-chain credit facilities, which are themselves a form of leverage. When the macro waters get truly choppy, when central banks are playing complex games with liquidity, and when geopolitical tensions flare, capital flees to the purest form of trust. Gold isn't leveraging anything. Bitcoin, in its current leveraged and interconnected state, can still be forced to act. This is the market telling you the difference between true safe haven and speculative digital assets that still rely on the stability of the broader financial system. This brings us to thread 2, the macro, policy, and currency forces that are ripping through this market. The big one today, the Warsh effect. Kevin Warsh's nomination as the prospective Federal Reserve Chairman has completely reshaped expectations for interest rate trajectories. The Fed, after 3 rate cuts in late 2025, is now holding steady at 3.75%. The January meeting showed dissent, but Warsh is seen as inherently more skeptical of aggressive asset purchases, more inclined to maintain a tighter balance sheet. What does this mean? It means the market is quickly repricing the pace and magnitude of future easing. Even though bank rate projects 3 more cuts this year, the market is now only pricing in a 32% probability of 2 cuts and a 30% chance of just 1. This tells you the policy outlook has suddenly become more hawkish. This shift directly impacted the US dollar. Initially, we saw the dollar weakening sharply after President Trump endorsed dollar weakness. But then, the Warsh nomination provided a crucial stabilizing force. The market reassessed. If the Fed is going to be less aggressive with easing, if balance sheet runoff isn't going to be completely reversed into full-blown QE, then the dollar suddenly looks more attractive than previously thought. The dollar found its footing. This is a classic example of what policymakers say they want. Trump wants a weaker dollar for trade versus what the system rewards. A Fed that's not going completely dovish supports the currency. Incentives matter more than rhetoric. We see this divergence globally. The European Central Bank is holding steady at 2%, explicitly stating neither hikes nor cuts are on the table right now, even as they show increasing sensitivity to euro strength. The Bank of England is expected to hold this week, but futures markets price in 4 cuts starting in April, despite an unexpected uptick in UK CPI to 3.4%. So you have the Fed potentially more hawkish under Warsh, the ECB on hold, and the BOE potentially more dovish. This divergence is a playground for currency traders, driving capital flows into emerging markets, which are broadly outperforming as investors seek yield and growth outside of developed markets. The Chinese yuan, for example, has seen modest appreciation against the dollar, strengthening over the past 6 months as China attempts policy stimulus. This global dance of central banks, each moving to their own rhythm, is creating the perfect storm for capital reallocation. And let's not forget geopolitics. WTI crude oil trading at $63.29 today, up slightly. Why the volatility? US-Iran tensions. The US downing an Iranian drone near a carrier in the Arabian Sea. Then President Trump emphasizing diplomatic channels are open, with talks scheduled for Friday. This creates episodic risk premium, the market buying oil on fear, then selling on hope. But here's the key. While oil reacts to geopolitical headlines, gold's move is deeper. It's not just Middle East tension, it's the World Economic Forum's Global Risks Report 2026 identifying geoeconomic confrontation as the top risk for triggering a global crisis. 50% of respondents expect a turbulent outlook for the next 2 years. Gold is reflecting that deep, systemic uncertainty, not just a single drone incident, it's an insurance policy against a fragmenting world order. Now, let's pull back the curtain on thread 3, the market plumbing and positioning. This is where the rubber meets the road, where the theoretical macro shifts translate into real-world forced action. Today's movements, especially the crypto crash, speak volumes about leverage and liquidity. When Warsh's nomination hit, the yield curve saw some serious action. 2-year yields fell 7 basis points, but 10-year yields rose 1 basis point, and 30-year yields rose 5 basis points. That's a steepening, meaning the market is suddenly pricing in both short-term ease and longer-term inflation or more restrictive policy. This repricing impacts everything, especially leverage positions. Think about the non-bank financial intermediaries, NBFIs. This is a hidden vulnerability. European banks, for instance, have increased their lending to NBFIs by $95 billion over the last year, reaching a staggering $1.36 trillion. Countries like Greece, Denmark, Italy, and EU. The Netherlands have over 10% of their total lending exposed to NBFIs. Why does this matter? Because NBFIs, like investment funds, often rely on open-ended structures, allowing frequent redemptions. They use derivatives, they build leverage. During market shocks, these liquidity mismatches can trigger sudden redemption calls, forcing asset sales that cascade through the system. We saw a small US bank failure in Illinois just this month, the first of the year, a tiny crack in the dam, but a reminder of underlying stress. The Financial Stability Board, FSB, is warning about vulnerabilities in the repo markets, those obscure but absolutely critical short-term funding markets. There's approximately $16 trillion in repo trades backed by government bonds. 70% of non-centrally cleared repo operates with zero haircuts and high levels of collateral rehypothecation. In plain English, massive leverage with very little protection. If repo lenders get nervous or can't meet liquidity demands, it creates forced selling, margin calls, and sudden liquidity stress. When the Fed ended quantitative tightening in December 2025, they started these reserve management purchases of treasury bills at $60 billion a month, trying to maintain adequate bank reserves to prevent a repeat of the 2019 repo market crisis. They're walking a tightrope. trying to contain their balance sheet while ensuring enough liquidity. But the sheer size and leverage in the NBFI and repo space means that a hawkish surprise from the Fed, even a perceived one, can quickly reveal who is trapped. This isn't theoretical, this is real-time plumbing stress. Spot versus futures spreads, for instance, can be a stress thermometer. If they blow out, it tells you the market is seizing up, and liquidity is drying up for certain instruments or regions. So, let's zoom out here for a minute. What we're seeing isn't just a short-term panic move. This is part of a longer-term structural trend. Panic spikes fade, but debasement trends persist. Gold, silver, and other real assets aren't just charts, they are trust instruments. They are where capital goes when the perceived safety of paper assets and the credibility of institutions starts to fray. The relentless rise of gold to $5,000, despite relatively high interest rates, is screaming that the market is pricing in sustained inflation, geopolitical fragmentation, and a loss of confidence in the long-term value of fiat currencies. This is not about the next Fed meeting, this is about the next decade. For you, the viewer, what does this mean practically over the next few sessions? Here's your mental checklist. First, watch market behavior, not just headlines. How do assets close? Does gold hold these gains or does it get sold off? Strong closes indicate conviction. Second, watch currency action, particularly the US dollar. Does the Warsh effect continue to stabilize it, or does Trump's rhetoric win out? Dollar strength or weakness dictates global capital flows. Third, pay close attention to bond yields and the curve. Is the steepening we saw today maintained? What does it imply about long-term inflation expectations versus short-term policy? Fourth, monitor spreads, spot versus futures for commodities, but also interbank lending spreads and any widening in corporate credit spreads. These are your stress thermometers. And finally, look for leadership. Is the rally broad-based in commodities and real assets, or is it isolated? This is about risk awareness and interpretation, not just reacting to every tick. Remember, there's a huge difference between physical exposure to assets and paper exposure through ETFs, futures, or leveraged products. When markets move violently, leverage can be a killer. Margin calls, forced selling, trading halts, these can quickly wipe out positions that look fine on paper. Understand your exposure. Owning physical gold is fundamentally different from owning a gold ETF or a highly leveraged futures contract. One has counterparty risk, the other doesn't. And when the plumbing gets stressed, that distinction becomes paramount. For those of you who want to dive deeper into these liquidity flows, the subtle shifts in central bank policy, and the real-time implications for your portfolios, we have a ton of deeper research and insights available in our community. We go beyond the headlines to explain the mechanics, the incentives, and the structural drivers that most people miss. To loop this back, what we witnessed today was the macro story unfolding in real time. Gold surged to $5,000, Bitcoin's simultaneous plunge, and the underlying tremors from the Warsh nomination, central bank divergence, and hidden market plumbing stress are all interconnected. They tell a single, clear story. We are entering a period where trust in institutions, in paper assets, and in the existing global order is profoundly being questioned. Market behavior matters more than headlines. Having a plan, not just a mood, is critical right now. The next few sessions will be crucial in confirming whether today was a turning point or merely a violent tremor before the real earthquake hits. This is education, not financial advice. Always do your own due diligence. Stay safe out there.